What if you could know when a stock is about to get tired, when its run-up is running out of steam, or when a sell-off is about to bounce back? Well, that's exactly what the Relative Strength Index, or RSI, is designed to help you do. The RSI is arguably the most famous momentum indicator in trading. It gives you a score from 0 to 100, telling you how strongly a stock is being bought or sold. When the score is too low, the asset is considered oversold. When the score is too high, it's considered overbought. In this quick tutorial, we're going to break down the two main ways you can use the RSI immediately. We'll show you why crossing above 70 or dipping below 30 is a signal you should consider, and the importance of 50, and finding divergence. This is a per-level move. How to spot when the RSI is telling a different story than the price chart, often predicting a major reversal before it happens. The RSI is simple to apply, but as every momentum indicator, it can give false signals in choppy or highly volatile markets. So you need to use it in combination with other indicators or chart patterns for confirmation. All right, let's start with the most direct and simplest use of the RSI, identifying overbought and oversold conditions. Think of the RSI as a rubber band stretched too far. Eventually, it has to snap back. But not always. Not every crossing of the 70 to 30 level signals a change in trend direction. This small mountain-like shape simply indicates a weak downtrend, and the trend is continuing its upward direction very soon. But you can use another part of RSI indicator to monitor direction change, the 50 level. As you see, 50 level divides the indicator to two regions of downtrend and uptrend. When the RSI crosses a 50 level and moves sufficiently up or down, a potential change in direction can be expected. Now we move into the pro territory, using divergence to anticipate major shifts in the market. This is where the RSI truly shines as a forecasting tool. Divergence occurs when the price of an asset and the RSI indicator are telling two different stories. They move in opposite directions. This conflict signals a critical weakening of the current momentum and often precedes a price reversal. This is a bearish divergence. Bearish divergence is a warning sign that an uptrend is losing steam and a reversal to the downside is likely. When you see this, it's a strong indication that the market is struggling to maintain its bullish drive and is running on fumes. Smart traders use this to initiate short positions or secure profits before the inevitable drop. In a bullish divergence, a downtrend is ending and a reversal to the upside is likely. This is the classic signal for a low-risk entry. It tells you that the market's conviction to sell is drying up and a move back up is likely coming soon. Hope you enjoyed this breakdown. I've got more trading insights coming your way, so stick around and catch the next episode. It's going to be even better.